Thanks for joining us today for another MyWealth webinar. My name is Jeff Hunter. I'm a senior investment associate and portfolio manager with the Townshend, Somani and Hunter Group. Also on the line, we have our senior investment advisors, Dave Townsend and Raheem Somani. For more information about our process and strategies, please visit mywealthmanager.ca or reach out to one of our teammates. Today is very exciting. We've had the announcement of the U.S. elections. There's been a lot of discussions, rates, markets, what's next. I think it's very timely and pretty excited to have Ben Fawcett on the line here. Ben plays a crucial role in our in-house equity portfolios, and he's a really strong resource for us as well. He comes to us with over 20 years of investment management experience, managed equity portfolios using both quantitative and fundamental strategies. Recently led a team at McKinsey as well as was a lead portfolio manager at Canada Life. Oversaw over $3 billion in assets and has a over decade-long track record of outperformance. So he's really been making an impact with what he does. He gives us a lot of institutional expertise and insight as well. He holds an MBA as well as Bachelor of Commerce from UVic and is a CFA charter holder. Also on the line, we have Mathurin as well. Well, he's our associate analyst. He also comes to us from McKinsey Investments, where he's a senior coordinator, oversaw and completion and execution of many high net worth orders and trades for mutual funds and ETFs. He's a UT graduate and recently, I believe, got his CFA designation. So congrats there. And our other analyst, Druv, he comes to us from TD. He was a member of their domestic fixed income rates team, has a very in-depth knowledge of the Canadian fixed income market and the intricacies of the trading floor. Previous was with Brookfield Infrastructure Partners, holds a Bachelor of Accounting and Financial Management from University of Waterloo. Our product specialist, Andrew Pennington, he came to us from Manulife Securities, where he managed their product shelf and product research team, who is the lead on many initiatives, included recommendation lists for advisors and dealers, model portfolios, and advisor book reviews. Prior to that, he was with the Canadian hedge fund manager of their operations and risk, and then previously with TD Asset Management. He's an undergrad degree from the University of Kansas, and a master's in organizational management, and as well is a CFA charter holder. And then Ben's co-manager on the equity portfolios and the lead portfolio manager of our investment team, Kevin Vandermeer. Kevin came to us after he launched his own hedge fund and worked for RBC. He co-managed over $3.7 billion, recognized as one of Canada's top gun investment minds, as well as a previous recipient of the Lipper Award for outstanding performance. So not only did he also manage money on a large scale, but was really good at it. He is as well a University of Toronto graduate, CFA charter holder, and a fellow of the Canadian Securities Institute. So Ben, we've got a pretty deep list of people here. Can you just tell us about how you manage money, your relationship with Kevin, what brought you over here, and just a little bit more about yourself?
Sure. First off, thanks, Jeff, Dave, and Raheem for hosting this, and thank the audience for taking time out of your busy day. Perhaps I'll start quickly, just an overview of sort of what we discussed as far as what I'll go through. Initially, I'll talk about the genesis of the fund and my discussions with Kevin, why I think it's particularly compelling product and process, and then we can sort of broach into some of the market information. If we go to slide 3, that's where the bio is. We'll start there perhaps. The genesis of the team was sort of Kevin joined 7 years ago, as you said, running institutional money at RBC with a huge focus on process, and at the same time, process and how do we get an edge. So the sort of the key aspect that we look at is process and evidence-based investing. He started the fund about in 2021, and then I started talking to Kevin about a year and a half ago, My prior experience, as you mentioned, actually started out on the quantitative side. So 25 years ago, working in investment bank in the UK, looking at UK markets and European markets on a quantitative basis. After an MBA in 2004, I joined Canada Life. My primary role there was to build models similar to what I built in the UK and Europe, but on a Canadian and US market. 2008, the lead manager on our fund actually went over to Fidelity, so I became co-lead at the time, and then lead in 2012. And it was at that point actually the role changed somewhat. We were still using quant as a guide, but going deep on the fundamental side. And this is where it was interesting talking to Kevin, because at RBC he started out very deep on the fundamental side, and over time came more into the quant. So when we started talking a year and a half ago, you know, it really resonated the way he spoke, and I think the way I spoke. We both had this deep belief in, again, that sort of having a clearly defined process, looking at the data evidence, back testing it, and then using that as a guidepost and combining that with a deep fundamental approach. So our initial discussions, it was very reassuring, actually. It was quite exciting. And that's ultimately sort of why I decided to sign up to the team and continue what we've been doing here. As far as summary, I suppose, as far as, did you want me to sort of just continue into the process, or did you want to sort of run through some questions here?
No, let's go to the process so that we can get to the timely topics. I think a lot of people are keen, just given the discussion that we've had over the last couple of weeks, and you know, everything was building up to the U.S. elections, and now what?
Okay, okay,
What?
yeah. I'll touch on a couple of attributes of the fund quickly. Slide 7, perhaps. Oh, sorry. We'll go back to the slide 5 or 6, is it? The prior slide. There we go. So if I'm looking at this fund, what are the key attributes about it? Again, it's a North American fund, so you have wide geographical diversification. If you invest in Canada, you tend to have too much on the resource side, too much on the financials. US, you've got this huge sector in the IT. I really like the sector composition of this. And I should talk a little bit as far as how we manage money from that standpoint, as far as we're not looking to make huge sector tilts. We're using stock picking process. It's a quantitative process with a fundamental overlay. And so we're trying to let the stock picking shine through, as opposed to making big macro bets and having the portfolio swing around a lot. If you look at the standard deviation of my investing prior to here and over the last year with this fund, the standard deviation or volatility is lower than the market as a whole. So it's a high quality portfolio, really focused on stock picking. I can touch on the investment approach a bit, but again, there is this quantitative aspect where both Kevin and I have, 25 odd years of experience investing on quantitative and fundamental approach. And investment edge is probably the key thing I look at with a fund. And it's sort of when I talk to other fund managers, what is your edge and where can you add value? And that is where we add value, that depth of knowledge on the quantitative side coupled with fundamental side.
Yeah, can you just discuss quickly a little bit more what quantitative means? I know it's our institutional clients are more familiar with it. Most individuals haven't been as familiar as to what it really means, other than it's quite long, wordy word.
And to be honest, it can mean a lot of different things depending on the different approaches you want. The approach we've both taken is looking for certain attributes in the market as far as what we think works from a stock standpoint. So looking at, say, valuation, free cash flow, companies, and we backtest this over 20 to 30 years in a lot of detail. We've got a team of 3 guys here that go through this. So something like free cash flow valuation metrics. Generally, if you buy companies with a good valuation, over time they'll outperform. There's other factors too. Return on invested capital. Strong companies with strong businesses have a good return on invested capital, and they tend to perform over time. Market sentiment and price momentum is also another factor. Companies that have been operating well and growing cash flow again, they tend to continue that over time. So there's a number of attributes when we're looking at the market that we can screen. And this isn't just randomly picking out. Theoretically, we come up with factors we think are important, and then we backtest them to see how they actually have performed in different market regimes over time, up markets, down markets, and then we assemble those and basically we screen the universe. So this allows us to look at the whole, the TSX, the S&P, global markets, screen them, and then rank companies accordingly. And that then gives us a short list of companies that we can look to invest and apply a fundamental overlay to. As far as sort of the other sort of key attribute of this fund is, from a manufacturing standpoint, there are no fees, and over time fees compound. So that's a huge aspect and a benefit here. Perhaps now just switch to some of the market commentary. If we go to slide 9. Going to sort of talk about where we are in the markets, but also just, where has that changed since election night? Where we had been in the market right now is a seesaw. Economic growth has been slowing. You had the Fed jump in and basically has the markets back, in the sense that if the economic growth weakens, then the Fed can cut rates. And it was actually this sweet spot, this soft landing that we've had with good economic growth, not too hot, not too cold. And if something goes wrong, Federal Reserve is there to back it up. What happened on the election? So it's looking like we'll probably get a Republican sweep. So what this is going to do is, this is pro-growth. There's a couple of factors that are going to happen from that standpoint. One is you're going to have some deregulation, which is going to impact companies in a number of areas. We'll see more M&A. You'll see less issues with the Department of Justice on corporate actions. We'll probably see tax cuts extended potentially, and this is where we have to see what Trump's priorities are, but potentially lower taxes as well. The one fly in the ointment from the growth standpoint, though, would be the tariffs that Trump is talking about with China and internationally too. I've got a slightly different view from that standpoint. I think he's going to come out loud. I think this is a negotiation stance. And then 6 months from now, I think we'll actually see a lot of negotiated tariff agreements, as opposed to, say, 10% on all global imports to the US, or 60% directly on China. The main sort of aspect sort of want to take away from the elections, though, is on slide 9. You can see what does the market actually do with different regimes, as far as a Democratic president, Republican president, divided Congress, or Democratic or Republican Congress. And as you can see, the analyzed returns are pretty similar in a lot of those scenarios. So the biggest takeaway I would have at this stage is not to try and call markets and the minutiae as far as around the election. I would be invested in markets, definitely from a fundamental standpoint. We're considering individual stocks, and we'll make some changes on the margins. Areas like that could be interesting, for example, with financials. Due to the interest rate regime and the cyclical aspect. There's a few other sectors that could benefit, and we've already seen a lot of that get priced into the market at this stage. So my overall thought is we're going to see a lot of noise over the next 3 months anyway. And even after that, it actually takes a lot to get legislation passed. You can do some things through executive order, but I think it's going to take some time before we see real concrete impact from stocks. So our approach to this has been to sort of own the market. Volatility did increase prior to the election. It's come down now. The markets are rallying. And overall, we're pretty constructive moving forward.
One quick question from the audience. Why was 2001 and 2 excluded from the analysis?
I suspect that would have been just because you had the tech bubble. So you had extremes of valuation and the market coming down aggressively during that. And it was a huge outlier. So that would, you've got data going back to 1933, but I think that was a huge outlier, that in an extreme situation, you can skew it. I would argue that we're not in that sort of environment. If I look at valuations at the moment, there's definitely valuations are up there, but we're not talking 99 type levels. If we can move on to slide 10. Similar story here. The next year, if you look at the data again, and that's sort of what we tend to focus on, have been pretty positive. The midterm election year, 2 years out from now, is where you get lower returns. And then as you sort of move into years 3 and 4, what we've just been through, they tend to be the strongest of the year. So again, if we look at the historic data, that's speaking to a solid performance next year. And I'll sort of touch on the fundamentals of the market a bit in the next couple of slides. We go on to slide 11. As far as what the market actually priced in after, because we've seen now more growth, like I said, the Fed had our back as far as what was going on in the markets. We now see more growth in the markets at this stage, so there's less need for the Federal Reserve to cut. So the market has started to take the expectation that the Fed is going to cut quite to the same extent. I still think we'll have another cut in December, and my guess is we'll have a couple more cuts early in 2025, at which point the Fed may want to start holding rates around 3.75%. Bank of Canada would be the other issue, and this is where it gets a lot more complicated. Canada needs the lower rate. The economic growth rate is obviously a lot weaker. I think the next meeting in December, the Bank of Canada still does 50 basis points. But again, it can't cut too far just because the US dollar is the big concern and protecting the CAD to some extent. I think there is some risk that, the CAD does weaken a bit from this point on, especially as we get the overhang of tariffs. And a final point on Canada is there's the US-Mexico-Canada Free Trade Agreement gets renegotiated in 2026. So that's a concern if you're looking to invest in Canada over the next, couple of years. What's that overhang going to look like? Flip over to slide 12. So what are we playing for as far as the market? What we have in that chart on the right is earnings expectations for the S&P for 2024. So at $243. Right now, the market expects 2025 earnings to be 274, 2026 to be 304. So if we're looking at that annualized return, that's low double-digit earnings growth. Like I said, valuations at this stage, profitability is very strong, but valuations are at the higher side. So base case I'm working with from a market standpoint and expectations is you sit in the market and basically as time goes on, the market focuses on the next year's earnings. And that's where you get your low double-digit earnings potentially for each of the next 2 years. So that's the base case I'm working on, assuming we don't have any huge sort of risk event. Moving on to slide 13. As far as the big picture then, where are we? We're 2 years right now into a bull market. Traditionally, bull markets last around 4 years, sometimes 3. Again, that would speak to this stage. You've got the strong earnings growth kicking in. You've got a Republican sweep likely. That's going to be pro-growth. So that can keep the market going for at least another year or two, base expectation. A couple things to watch, though. One would be tariffs, and what does that do for inflation? If inflation starts to pick up in the US, especially in a pro-growth regime, you're also going to see bond yields start to move up, and that can actually put a bit of a cap on the equity market. So a few levels right now are about 4.35% on the 10-year yield. As we start to approach 5%, if we did, that's when I'd start getting quite concerned from an equity market standpoint. But if I look at the bond markets and credit spreads and other indicators, they're actually very tight. Shows the market is actually pretty comfortable at this point with the growth and the outlook. The final point then is, what happens with the Fed and Trump. He doesn't come until January 20th. For the time being, I think the focus stays on the Fed and the cuts we get in December and potentially the spring. The noise is going to increase as far as what is Trump's mandate from that standpoint. So that's where we're sort of going to keep a close eye on. There's going to be a lot of details, a lot of nuance, and there may be some opportunities in there. But overall, I do have to say, our focus is to stay invested. And I'll add that just as an overall sort of policy of the fund, it is to stay invested. If you look at down markets or up markets, they happen 75% of the time over the last 100 years in the S&P 500. So if you're going to get out of the market, I always think you need a really good reason to, because the odds are the market's going to go up in any given year. And so that is always our default. And the bar to get out of the market is very, very high. So as a general policy, we'll stay invested and we'll sort of look at our stock positioning and the names we own. Move on to slide 14. Just want to give you sort of an indication of how we actually invest using both what we're talking about from a quantitative standpoint and a fundamental standpoint. So here we have a couple of trades we made in the prior quarter. I'll start with Manulife, which reported today. From our standpoint, the model score would be 2. So that's ranked out of the TSX. That would be basically ranked number 2 out of 225 companies in the index. And then we have different factors we look at from a quantitative standpoint. And there's a lot more that goes on behind those numbers, but those are rankings. In these cases, we're looking at the size of the company, the volatility, different valuation metrics, and different sort of price and earnings momentum indicators. So that's where we start as far as this company gets flagged on our model. We can then dig into the fundamentals and look at what's happening with that company as far as it's spinning off some of its US business that had been a drag. The asset management business, as we saw today, is growing very quickly. ROE has been increasing. We're at 16% ROE right now, which is better than a lot of the Canadian banks, and again, at a better valuation. So that's where the model will sort of narrow universe for us. And at the same time, we can then add a fundamental overlay to say, do we agree with these numbers, and do we, think we can get the earnings growth over time? T-Mobile would be a recent addition, or a couple of months ago on the US side. This is a company we wanted more exposure to at the time, falling rates, with a stock that has a decent dividend yield, in this case 3%, but at the same time has a good underlying growth engine due to some of the M&A. So there's a sort of compounding or combination, I suppose, of those quantitative indicators which flags the stock, and then we can look at individual attributes of that name and make our decision from that standpoint. I'll give you an example of a recent sell too, and it gives me a chance on slide 15, gives me a chance to talk about the chip stocks and NVIDIA. Over the summer, we sold a position in Lam Research, again, semiconductor manufacturer. I think there's some really interesting observations as far as what's happening in the chip space right now. First half of the year, we saw the whole space run, and it's about 12% of the S&P 500. So there's a lot of different names in there. What we've seen since then is this narrowing. The companies that can actually grow earnings, NVIDIA would be an example, Broadcom, 2 holdings that we continue to hold, have continued to perform, where the rest have actually started to underperform the market overall. And that again shows up in our numbers. NVIDIA right now has actually a very good score in our model, where Lam Research is ranked 408 out of 500 S&P companies. So some of those factors are showing up in these models, and that actually helps us screen down the universe and sort of decide where we want to act and focus.
You said you trimmed earlier on there. At what point did that CGWM score change, and how does it reevaluate itself?
There's a couple of aspects that'll come in. One is we didn't see some of the earnings revision, so valuation score was not improving. As the shares started to move up, the valuation score deteriorated. If you look at NVIDIA, the earnings revisions last year or for 2024 have been massive. As a result, the valuation actually didn't change much as the stock moved up because it followed earnings up. A lot of the other chip stocks just didn't get the earnings growth that, say, NVIDIA did, and we saw that, and as a result, their valuation started to increase. The volatility on the risk side has been pretty high for all these names, but tends to be even higher for names that don't actually have a valuation backing. And then momentum is another from a price standpoint, both earnings momentum and price momentum. that starts to turn, which sort of signals to us that something's going on here. The market has highlighted that there's a problem, and it is starting to differentiate between these companies. So we've actually got a huge dispersion now in scores within a subsector, which is sometimes unusual. Often subsectors tend to move together. But it really is becoming increasingly a winner-takes-all game, which at the same time, I will highlight, when a market gets narrow like that, that's a concern. When it's broad and everything's running, there's a lot of positive momentum there. So as the market gets selective, in one hand, it is actually looking at earnings and who can perform, but at the same time, it shows sentiment has changed, turned on the chip stocks. And so that's a red flag there. And we have trimmed a bit of NVIDIA. Perhaps moving on to 16. Just got a couple of minutes here. This is just another publication we put out every 6 months, looking at some of our top picks in Canada and the US. This was as of July. All good names. They tend to be higher quality names. A couple of comments there, perhaps. Couche-Tard at this point, this is one where we've moved to the sidelines. They're in the middle of a huge, or trying to acquire 7-Eleven brands out of Japan. This is going to be protracted from our view from a fundamental standpoint, and I'm not sure they're going to get the sort of accretion they need at the end of the day. So that's one we've sort of moved out of. Hydro One, again, very high quality utility company. As rates came down, valuation really started to move up on that and on our work. The score degraded, so we've actually been selling that out of some portfolios too. On to slide 17. Just want to sort of touch on the other funds then. So there's a North American equity portfolio, which is basically, like I said, 50% Canada, 50% US. There's also a Canadian dividend portfolio, pure Canadian equity portfolio, and then an S&P 500, a US focused portfolio, and a new addition actually, an EFI portfolio, so an international fund that covers Europe and Japan. Again, similar process with all of them.
Can you just touch on, these are pure stock portfolios, so investors actually own each individual position, can see all the interactions. It's got much more clarity as to what is actually operationally happening in the portfolio. How many stocks do you typically trade within each portfolio?
They could be 40 to high 50s. Generally, I sort of go in 40 to 50. A little bit over in some right now, under in others at the time being. So it's fairly concentrated. Historically, I've actually run more concentrated portfolios, 30, 35 stocks, and did that while keeping, like I said, volatility lower than the market. With a quantitative process, it actually helps a bit to have a few more names there, reduces some of the volatility and the risk. So I've found this is a sweet spot as far as not too many names. You can still know your names, you can still be on top of them, but it does smooth the ride. And a huge part of investing from our standpoint is reducing that volatility, because you need to be in the market over time. That's how you get that appreciation.
And from that space, how do you decide position weighting?
A couple of constraints, and this again comes back to the back testing standpoint. So it's pretty scientific from that standpoint. We look at the active weight. So we take away whatever the index weight, and this is important with some of the big US holdings, for example, where you have, say, Microsoft at a 7% index weight. We look to have an active weight, which what we call is that's the divergence from that benchmark or index weight of up to 150 basis points. Sometimes we'll let a stock go to 2%. So you need to, there's two sides. You need to make your calls meaningful, but at the same time, you don't want them to be too big, because otherwise they swing the portfolio around and you have to stick with your positions. So it'd be 1.5% to 2% active weight. And the other side is from a sector standpoint too, where we constrain that too. So you'll generally find we have holdings in most of the sectors. Some of the smaller ones like REITs and utilities, we won't at times. But again, we're trying to create an all-weather portfolio. So we don't want it to work just in this environment, because those macro headwinds change very quickly. You're coming into a US election, you don't know what the outcome is. There are a lot of surprises here too. So you want to make sure you own companies from different parts of the economy, and then you want to focus on the best companies within those different buckets. And that's how you smooth some of that volatility while still sort of generating the outperformance. And any other questions at this stage? It sort of covered most of the key areas I wanted to speak to.
For those in the audience, there's a Q&A button. If you type it in, we'll ask them on your behalf. And we can go from there. Dave, Raheem, do you have any initial questions?
Yeah, Ben, thank you for your time. What are some areas in the market, whether geographically or by sector, that you're keeping your eye on, that you're starting to see value presenting itself? I think there's been a march towards precious metals, but that's already come. I believe a lot of people are focusing on energy, but are weary of the U.S. position right now on, drill and drill away. But even geographically, are you looking at markets or certain sectors that may manifest themselves, in the first quarter of 2025?
Sure, maybe I'll start with the commodities side. From an energy standpoint, I actually don't think it matters if they open up drilling. The US already has lots of great land that can be drilled. So I don't think that's the big constraint. The big constraint has been the oil price. You need the right price to justify spending that capital. So as far as loosening up some of those restrictions, I don't think it changes the cost that much from this standpoint. The bigger issue, or two bigger issues with oil, one is the OPEC overhang and what they decide to do. If OPEC can stay disciplined, I think that supports oil. I think in a strong economy like this, we probably are bouncing around the bottom from an oil price standpoint. But that OPEC overhang is capping it, say at $90 or somewhere around there. The other concern I do have is from a China perspective, which has been a very consistent grower of oil demand over the last 20 years. And, this year we saw them switch to 50% of new cars sold in China, hybrid or EV. So Chinese demand has been very weak. And, there's a big question mark whether that continues. Nat gas, I think, can get interesting with all of the LNG products in the US and in Canada, as well as the energy transition is probably going to be very focused on nat gas, to be honest. Renewables have their limitations. Nuclear takes a long time. So I think we're going to see strong demand for nat gas. Gold, we've been invested there. Like you said, it's run pretty hard at this stage. The one area on the commodity side is copper, actually. I think the market may be too focused on China and tariffs. If you look at copper demand, it's 65% of copper demand globally comes from China, and Chinese demand for infrastructure copper or manufacturing actually hasn't been increasing for the last 5+ years. It's all been coming from building out the grid, building out renewables and EVs, like I mentioned, in China, and that growth is going to continue. So there's a really strong Chinese growth story for copper on the demand side. Supply still looks pretty tight. So that's an area I'm sort of getting more constructive. As far as the rest of the market, financials is definitely an area we've sort of moved into in a significant way. I think some of the election data, even prior to that, is pretty positive. Like I said, as far as interest rates for banks, for example, valuations are still pretty compelling. Capital markets, I think, are going to be helped. Insurance, even in a lot of these insurers now on the Canadian side look pretty interesting too, with Manulife with a 16% ROE. Sun Life's not far behind, and yet they trade at discounts to the Canadian banks. So lots of activity in the financial side. And then, to be honest, in this environment, we're probably looking at more subdued markets to what we've had in the last couple of years. And this is where I'm still looking at some of the mega caps, be it Amazon, Google. They can sort of put out 15% earnings growth, good year, bad years. They've got a lot of levers to pull. And in a market where we're really focused on who can actually put up the earnings, I think those are great places to sort of keep in a portfolio as well.
Now, one aspect quickly is, AI and artificial intelligence and machine learning. And, in your evaluation, do you look at companies who are driving productivity through, a technological advantage, utilizing AI and machine learning? Because a lot of money is being invested in that space. The mega caps are, definitely using it to their advantage just because of scale and ability to utilize it within their products and services. Is that something that's you guys look at when evaluating certain types of companies?
Yeah, definitely. I think there's a couple of aspects with AI. I'm personally a believer, and I think, over the next decade, we're going to have huge changes, huge improvements in productivity. Even an underlying macro view, I think we are seeing productivity start to tick up. And, those can be long-term trends, and I think AI will help on that. The big thing to keep in mind here is there's a lot of hard work that has to go on. You can go from ChatGPT 4 and assume it's just going to be this linear progression. And I think we've got a few years of hard work to actually sort of embed a lot of these products and get them to the point when they are prototype to actually production. Right now we're very much prototype, and this is what we could be doing with it, but we need to get them to full production. And so over the next few years, I think you're definitely going to see some benefits. Companies like Thomson Reuters have been using AI, using Amazon's cloud service for years with their Westlaw Edge product, which is really, really impressive. And I think on the margin, you're increasingly seeing more and more companies do more with less people, basically. And another side would be actually Meta, what they've done as far as targeting advertising. And you're seeing that on YouTube too. I mean, that's a lot of AI driven, increased engagement. You now have over 3 billion people a day using one of Meta's products. So it just shows how they've managed to really sort of improve that engagement. And that's through huge AI spend. So I think we're already seeing some benefits, but it's going to be a long haul.
Just one quick one from the audience. I know you've touched on a little bit, but especially today with the Fed cutting 25 basis points. What do you expect in the bond market? I know it might be a tale of a couple different bond markets, but
Yep.
where do you see that?
Yeah, I think I was just looking at the yield curve right now, and it is very flat. If you look at sort of the 1 year versus the 10-year, they're all around 4.2 to 4.3%. I think we're going to get more term premium in the bond market. So I think those longer term 10+ year rates are starting to move up. And I think that's going to be good ultimately for the financials. This is the canary from my standpoint that I'll be watching for as far as the canary in the coal mine. If those rates start to move up too high, I think that indicates that there's too much growth. We're starting to see inflation. Tariffs can have an impact on the inflationary side too. And so, as we go, if we go 4.5%, that's when I start to get worried. Like I said, at 5, I'd be very worried because we saw what happened at 5%, and it did finally start to have an impact on the economy, and we did start to see slowing growth. So I don't think it'd be positive if we move up to that level. It definitely puts a cap on equities if we do.
Just
So,
on the tariffs, as you touched on that, we went from just in time to just in case shipping from COVID. There has been a lot of onshoring. Has it dampened some of the risks of some of those tariffs in previous cycles, or what are your views on that?
yeah, no question about it. 2016 to 18, I think China was somewhat shocked by Trump's approach there and had to scramble. They knew this is coming or has been increasing risk. So if you look at foreign direct investment out of China, they've been investing heavily in the countries around China. They've been investing in Mexico because they realized this is a big risk. So they moved a lot of their manufacturing capacity out of China. That said, China still is in a very difficult economic situation right now. So this isn't good news from them, but they have definitely managed to mitigate some of the effects. And they also buy less from the US now. Things like soybeans, they've moved a lot of that to Brazil and other places to lessen that reliance.
With the massive improvements in Mexico investment, and you talked about the Mexico, Canada, US prior NAFTA agreement. Do you see Canada being in any spotlight as a result of the growth in onshoring onto Mexico and infrastructure built there?
As far as Trump sort of trying to limit what happens on the Canadian side.
Yeah.
Yeah, I think it's a headwind, to be honest, and we've already seen the government start to comment in the last couple of days, saying, what's happened on the election here. There's a real concern. Canadian economy is struggling right now, and so we need investment. And when you have this overhang of either a 10% global tariff, which I think in reality takes a lot to actually make that happen, or renegotiation or NAFTA, that does make investors pause for a second. So I think it's a concern, no question about it.
Dave, any thoughts or comments?
Quickly, what would you model to say, let's say we have a change in government in Canada, what would that look like?
Yeah, that's where it gets interesting, because that was the second point I didn't get to is, this will be 2026 when those NAFTA negotiations really kick off. And, there will be likely a different government if you go by the polls, and that could happen quite soon. And you've seen the positioning between both the conservative leadership and communications with Trump already trying to sort of set the groundwork there. So I think there is, to be honest, this could be the impetus for some structural change in Canada too, is another way to look at it. It could be a positive catalyst as far as different parts of the Canadian economy and potentially even opening them up potentially if Trump pushes hard and, you had a different government in Canada. I'd be definitely keeping an eye from that standpoint. So it is one thing to look at the current government and their relationships and how this goes, but, realistically, where are we 6 months from now, potentially, or certainly 12 months from now, and that can mitigate a lot of these impacts.
Yeah, very good. Here in the West, we're looking at, some very restrictive energy policies, and I don't see that that's going to go well with a liberal, with Trump in the White House and the liberals here tightening up the oil and gas business. So I think it's, we're going to have some type of resolution politically here, but that's a great answer. Thank you.
No,
So
I agree.
one of the questions is what kind of structural changes in Canada are you referring to?
It could be from a number of areas. One is taxes, obviously a huge one. You're likely now to get, again, it's going to be interesting. Trump is going to come up with a big list of things he wants to do. Obama did that too when he had a sweep. The reality is you've got 2 years. You have to really pick what are your priorities. It takes a lot to get these through. So where's it going to be? Taxes, very good chance it's going to be a key area. So you're going to get extension of existing tax cuts late 2025, and you may get new tax cuts, which puts Canada in a very awkward position because the reality is, we have a very big border and that's our trading partner. So like it or not, we have to play along with what the US is. Otherwise, investment and people are going to head south. So Canada has to play ball with that. And so I think from a tax standpoint, that'd be a big issue on the corporate side. Then, marketing boards always come up in these sort of situations. Like I said, energy policy could be another area. Foreign investment in telcos is something that I hear that comes up every now and again. In the banking sector, more open banking. There's areas of the Canadian economy that could be made more competitive probably if you open them up a bit. So there's a lot, and you have to definitely watch and see what happens, but there's a lot of places to watch.
Perfect. Dave, Raheem, anything else?
Well, no, but it's just interesting. It looks like we're going to have the German government fall. So the Western democracies are certainly moving a little off center or, to the right. And I think it's going to be very interesting for international trade. That's it for me.
No, I agree. There's been a lot of change actually globally, to your point. And that was probably a big indication of what was going to happen in the US actually. Yeah.
With that, Ben, I really appreciate your time and all the support that your team provides to us. We really do appreciate it, and we really appreciate everyone who joined us on the call today. Thank you for sharing your lunch hour with us. Feel free to reach out to anyone on our team. We're more than happy to discuss any sort of topics, macro or micro related. or any longer term financial strategies to put you on the right track. With that, have a great day, everyone. And for those in Calgary, enjoy the warm weather that we're getting today. It's a nice break.
Appreciate the time. Have a
All
great
right.
day.
Take
Bye.
care. Bye for now.